Hi, everyone. Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. In addition to being the dividend guy, I'm also the biotech guy. Now, how does that work? Well, it's kind of like a barbell approach. On one side, you have your conservative investments, your dividend payers, bonds, and other income producers. Then on the other side, once your dividend portfolio or income portfolio is complete, then you go to the other side and you can be more speculative. So having a solid income portfolio allows you to try to hit home runs in the biotech sector. Now, I got involved in the biotech sector in 2004 because I realized that no other sector had the same potential for the enormous gains and sustained growth. Now, you've probably heard the stats by now. 10,000 Americans turn 65 every single day. And what do we know about people as we get older? They consume more healthcare. They need more medicines, more doctor's appointments. And as the Oxford Club's biotech expert, I'm often asked what I look for when choosing biotech stocks. So here's some of the things I want to see. Game-changing technology. Now, I'm not interested in a company that has a cancer drug that adds 2 more months of life over the existing standard of care. I want to see entirely new approaches to treating disease, something we've never seen before. Safety, that's really important. A drug is unlikely to get approved if it's unsafe, no matter how effective it is. I pay particularly close attention to phase 2 trial results because that's usually the first real indication of whether a drug is safe enough to try in a larger population. Upcoming catalysts. Biotech stocks can move quickly on news, and I don't want to be sitting with a stock for a year and a half waiting for clinical trial results. I typically want to see important trial data within 6 months of buying the stock. Cash on the books. Now, most small cap biotech companies are unprofitable and burn cash. Now, I'd rather not be holding the stock when management decides to sell shares to raise capital. This dilutes existing shareholders and causes the stock to drop. Now, if the company has a lot of cash already, it reduces the chance of seeing a stock offering. Smart money. I like to see investors who I respect own large holdings in the stock. So when I see investors like Felix and Julian Baker or others, I know some major league brain power has reviewed the company's science and investment opportunity ahead of me and has decided to move forward. So my confidence is also boosted when insiders own a lot of shares. And from there, I'll dig into the clinical trials, investigate management to see if there are any red flags, but the above list is a good start. Now remember, no other sector regularly sees stocks move 50% or even more than 100% in a day. In April, Capricor Therapeutics leapt 359% in one day after it reported positive clinical trial data. In May, Adaptimmune flew 339% after posting positive data for its cancer drug, again in one day. And on March 18th, get this, Humanigen closed at 45 cents. The next day, it spiked as high as $2.04. Less than 3 months later, it cleared $6 per share. It spiked 353% in one day and 1,300% in 2.5 months. Now, I would argue biotech is the most important sector in the market and will be for the next 5 or 10 years or even further. Your portfolio should have some exposure to it in order to take advantage of its enormous potential. To learn about 3 biotech stocks with big upcoming catalysts that could produce enormous gains, click on the link. I'm Mark Lichtenfeld. Thanks for watching State of the Market. I'll see you next week.